Hi, so it is IPO season again with a lot of buzz around some new age IPOs so called. So let me tell you a few things which actually I've been repeating over the years. One, there is only one way to value a company, whether it's a listed company or about to be listed company or stock. And anytime you are told about great new valuation parameters, those are usually just a way to justify a number rather than do a real valuation. Two, if you are looking at the so-called big names investing, whether they are large private investors or institutions or venture capitalists, remember a few things. One, that if you're looking at, for example, venture capitalists who have invested in the stock, remember, first of all, most VCs invest in companies as a portfolio. They fully expect 60 to 70% of their investments to go to zero, the rest to make normal returns, and they hope that there will be 2, 3, 4 which will become multi-baggers, will kind of be the next Google. So they are investing like that. You are buying one security, which is a different thing altogether. And even the mutual funds applying for some of these IPOs say, oh, but it is only 0.1% of our AUM, but that's not the case when you are investing. It's another matter whether they should be investing at all or not. But that is one. The other thing is that often these investors have entered at a much lower price. So most of these IPOs, the valuation in the IPO is 2, 3, 4, even 8 times the last fundraise. So the other investors have entered at a totally different price. Many of these IPOs also have an offer for sale component. So the big investors are not just not buying at the price at which you are buying, they are selling at the price at which you are buying. You are providing the exit to them. And there are always rosy projections, and last time you had this cluster of new age IPOs was in October, November 2021, and I was looking at some of my interviews from back then, and I remember an anchor saying, Devina, if I put a gun to your head, which one of these IPOs would you buy? And I said, given gun to my head, I would not buy any. But more important, at that time, the anchor also asked me that right now the valuation might look high, but 3 to 5 years later, the growth will be much higher, the margins will be much bigger, and then the valuation would look okay. And I had said, anything can be written in an Excel sheet. And just to give you an example, not that it's the worst example or anything like that, but Nykaa, for example, also was part of that cluster that went public in 2021, and its ratio, whether it's cash conversion, margins, growth, etc., peaked in that year just before the IPO. So the net margin was 2.5%, then it is 0.9% now. So instead of expanding, and this is 4 years later, you are where you are. So those are the things. Always it is easy to make rosy projections, so be very careful when you are buying something that obviously looks very richly valued. And do your own due diligence. Don't take it as a shorthand that so and so has invested, so it must be a good stock. So I hope that helped, and it takes you to the root of more sensible investing.